Now, what is meaningful, I would say, is what happens to interest rates in Japan. Because at the present time, Japan spends 43% of its tax revenues on the interest payment on the government debt. And we have artificially low interest rates in Japan as well. They are on the JGBs around 0.4%, the 10 years. So if these interest rates in Japan doubled, all the tax revenues would have to be used for the interest payments on the debt. And then you come into a situation that potentially could be very dangerous.
So, Mark, which stock market do you like the best? I mean, you mentioned how Germany has definitely outperformed, but if you're looking at the rest of the year, where would you tell somebody is your favorite place?
Well, that depends on your risk profile. I think this year Europe will outperform, and I think actually that also European real estate is relatively attractive because the yield spread between the yields on commercial real estate and the bond rates and bank deposit rates are huge at the present time. I also think that there are some emerging markets that will outperform the US. Since the summer of last year, the Chinese A-share market has enormously outperformed the US. We've been going up very strongly. Last year, India outperformed the US very meaningfully. So there are some situations. I happen to quite like Chinese stocks. And let me explain you why. I think overall, the economy is weaker than what the government is saying. And I believe the economy will decelerate further. But the share market can go up because it's been a gross underperformer over the last, say, 7 years compared to other markets in Asia, compared to the rest of the world, compared to the US in particular. And the Chinese government, they have the tools to essentially ease. They may not opt for having a weaker yuan because it may suit them to have a strong currency in the long run, because they want to establish kind of the yuan, I mean the Chinese currency, as an international tradable currency that grows in importance. But they have other tools, and they could ease, and that may move money into equities, in particular now that the property market is weakening. So the money no longer flows into the property market for speculation, but into the equity markets.